Gold and silver just hit a sharp speed bump after a strong run higher, and traders are now watching closely to see what comes next. Both metals turned lower across recent sessions, with enough force to signal something more than routine profit-taking. Moves like this, sometimes called violent reversals in trader shorthand, usually point to a shift in positioning rather than a change in the bigger picture. In other words, the traders who are leaning bullish are stepping back. That alone can move prices fast. So, what tends to trigger these sudden drops? A few things. First, a strengthening US dollar puts direct pressure on gold and silver. Because both metals are priced in dollars, a stronger dollar makes them more expensive for buyers in other currencies, and demand cools quickly. Second, any shift in expectations around Federal Reserve policy can spark rapid repositioning in the futures market. If economic data comes in stronger than expected, traders who had been betting on rate cuts may unwind those bets in a hurry, and metals feel it. Silver tends to amplify these moves more than gold does. That is because silver carries a larger industrial demand component. When risk appetite shifts, when traders get nervous, silver tends to fall faster than gold. It can also bounce back more sharply when sentiment turns. During pullbacks like this one, the gold-to-silver ratio becomes a key metric to watch. It tells you which metal is under more relative pressure and can offer early clues about how positioning is shifting. For gold specifically, the technical picture comes into sharp focus after a reversal this size. Traders will be watching key support levels, moving averages, and prior consolidation zones. The central question is whether this is a healthy reset within a broader uptrend or the start of something deeper. History offers some reassurance here. Gold has tended to find buyers during pullbacks when the macro backdrop remains supportive, and right now that backdrop still includes inflation concerns, geopolitical risk, and consistent central bank demand. Central banks do not stop buying gold because of a day or two of price swings. Institutional and retail buyers also tend to step in when prices dip, which can put a natural floor under corrections. That said, when positioning gets crowded in a rising market, a sell-off can run further than the fundamentals alone would suggest. Momentum matters. The practical takeaway right now: watch the next round of economic data, especially anything that touches Fed policy expectations or dollar direction. Those prints will likely decide whether this pullback stabilizes here or has further to run. Bullion Flash is brought to you by Absolute Bullion, a California-based dealer in gold, silver, platinum, and palladium. More at absolutebullion.com.